Netflix just made a surprising move. They are adding live sports and TV channels to the platform. Yep, that's right. 25 years after helping to kill cable, they're kind of bringing it back. Are they going full circle or just doing what works? And more importantly, is the stock a buy right now? We'll break it down. Let's go. Welcome to another video. My name is Robin and I am joined by a special guest. No, just kidding. I'm joined by Kirill, who's always here. Today we're going to discuss Netflix. Uh, and they made this announcement that in France they're going to do some sports and live TV. We have a three-step valuation method. And we'll start with what's in the news. We're going to go over the company fundamentals. And finally, we're going to leave you with the value that you're going to get out of this video, the valuation of Netflix. So normally Kirill will take it away with what's in the news, but I would kindly like to share what they're doing. So they're moving to incorporate a broadcast-style television feature like live sports and linear channels, the one that you used to know from cable. And basically why they're doing it is because they want to expand their subscriber base, increase engagement, and explore new revenue streams. And basically, this will be rolled out in France, as you can see on Kirill's Los Angeles Time page here. But it's also likely not to go to the US at the moment because it says here that the TV economics do not make sense there, but more deals are likely to follow in Europe. So this is interesting. Kirill, do you have anything to add? What's your opinion on this move?
I think we have already discussed it, I think, in one of our previous videos about Netflix. It's pretty much a good idea from the perspective of let's get as much content out there as possible. Let's get people just really to open Netflix like every day. If you want to watch TV, boom, you go to Netflix. If you want to watch a movie, go to Netflix. You want to play games, same. Where are you going to go? Netflix. So it's more like they're just fighting for the time of consumers and doesn't really matter what it is about. And it's actually kind of a good idea, but it's also quite costly because you have to pay all of these licensing fees and stuff, because Netflix of course started making their own shows and movies. That's nice, but you cannot really make your own games. Let's say it's really hard to make another GTA 6, right? For instance, or any other game. It's just too expensive, let's say. But the move is quite sensible, because you can also see how troublesome it is for the other platforms like let's say Disney or HBO Plus and stuff like that, when you're kind of just stuck with certain content, right? And you're all fighting for the same pie, but you have to find that differentiating factor, and that's what Netflix is probably trying to solve.
Yeah, exactly. Yeah, and to add to that, like most of the bigger producers, for example, like Disney or HBO, they are setting up their own streaming platform. So it's increasingly difficult for Netflix to pump out shows. Of course, they have their own productions and they are purchasing these different IDs and series from other creators, basically. But yeah, it makes sense. There's so much content out there, and people they don't know what to watch anymore. So most of the time, people are just sitting in front of their screen, deciding what to watch, and that maybe takes more time than watching the actual content itself. So I think it's good just to have something out there, even though we're gonna go back to square one and go back to more television-based thing. But yeah, I think it's a good move. Also, getting people on board who have different interests than watching series or movies, and they also want to have other cable-like experience. All right, so Kirill, let's go to 9:30 and let's go into the fundamentals of the company.
Yes, sure. I already have it open. And basically what we can see right off the bat is two things. Of course, the amazing comeback of the stock from the lows of 2022. But also, it's a quite an okay-ish, it's a C for a 930 score. So you can see they're still not the best when it gets to the margin part of things. And you know, at least what they're really good at is the stock price. Stock price performance is doing, yeah, darn good. let's put it like that. So yeah, it's just a growth stock. It's a tech stock. And what's also really interesting to see is well, the PE of 56. It's on a bit of a high side. But there are also a little bit of red check marks on the company foundation.
Yes, yeah, these are, we addressed it in our previous video. We still are developing a way to change the time limit between these fundamentals, let's say. So they're on the maximum amount of data we have on Netflix. So it is going to be a bit weird numbers, probably due to some heavy outliers. But these check marks are indeed a good place to start. And also, it gives us a bit of a direction where we need to look at, because I see that their long-term debt is, for example, not covered by free cash flow. They do have negative share buyback, so they're diluting you. They're also not giving a dividend, so they're not really providing any value to the shareholders other than increasing share price if the news allows it, let's say. And then they also have negative free cash flow growth. So these are all signs that we can look into. And also, as Kirill mentioned, we already saw in the 930 score that they don't have that great of margins, and it's probably due to the fact that they do have quite tough competition. You have really established names like Disney and HBO, who are also on the block trying to compete with you. They have insane budgets, probably similar to Netflix, and they have to compete. They have constantly have to innovate, and all these things will cost money, and it will hurt the bottom line. So, Kirill, let's go into the key financial ratios, and let's see where it's hurting the most.
Yeah. And I think it's also important to say the part related to the price sensitivity, right? Because you can see, like, whenever there's a price increase on Netflix, you would hear people complaining all over the world. So of course they need to increase the revenue part in order to sustain high expenses. So that's also a bit of a tricky part of things. But you can also see, like, there's still revenue growth. It's of course getting more or less to I don't know, depending on how it works out later, but it kind of gets to a plateau already for the last couple of years. But also as well as the R&D expenses, for example, in this case, and the depreciation and amortization, because of course when you have to, let's say, write off all of your shows and everything. So it all makes sense so far. And with regard to the shares outstanding, we're also, as Robin said, they did a little bit of buybacks back in 2024, but before that there was minor dilution all the way, pretty much starting from 2010, 11, let's say. So it's kind of probably good to see that they are starting to buy back the shares already again, probably because the bottom line would also improve, because you can also see the pre-tax income is also getting better. So that's a good sign. That's a good sign. And what we can also see is the part related to free cash flow. Finally, it's getting to the positive signs. That's a good thing. So for the past 3 years. And also what's good to see is that they're gradually paying down their long-term debt. So that's also, it's good to see. And again, as we always discussed it before, could be all the COVID money, good loan terms that they just have on the balances, and they're just gradually paying it down. That's all nice. That's all nice to see, to be honest. But it just only happened pretty much gradually over the past few years, only a couple of years, let's say.
Yep. So let's go into the ratios and see how it looks there. So research and development ratio is now it's on back to okay levels. So it's like 16%, average 21. That's okay. We are looking here for anything below 25%. So that's good. Let's see. Their net earnings ratio is on average 8%, but on all the years. But now it's going to 27%. So that's actually pretty good. So that bottom line is looking better and better. Revenue has been slowing down, but of course that's not really weird in a sense, because they are looking into different markets, right? So they are looking on how to grow their revenue, how to grow their audience. I mean, if you capture at one point the market, and especially when competition is getting tougher, it's not weird that revenue is gonna stagnate. Can we go down a bit, Kirill?
Yeah, sure.
So yeah, gross margins look good. Operating profit margin looks decent. So yeah, it looks a lot better than, of course, we saw in previously in the fundamentals.
Yeah, so let's say, just to summarize, what's good is that they're finally getting their house, let's say, in shape. So they're improving their expense part of things. But the biggest problem is actually right here. So from starting from 2021, it's really getting harder for the company to make more revenue, actually.
Hmm.
So now the question would be, is it actually worth paying, let's say, such a high multiple of 56 for the stock? Because it really bounced to some crazy numbers. Of course, it shows the profitability, but is it justified? That's the most important question to ask in this case.
Yep.
Shall we move
So
on to valuation?
let's jump into the valuation.
Yes.
I also had some statistics. I grabbed some statistics real quick
Mm-hmm.
just to, if we're looking at growth, for example, we just discussed growth, and I was quite curious. So we can just go through it, and then I'll just notify you when I have something to add.
Yeah.
So first, we can always we use the last year's free cash flow starting point. You can use something else if you want. So if you have an idea, for example, how it will be next year, you can start plugging in that. So you can basically play around with different kinds of numbers. That's also, of course, the beauty about this web app. If we look at the projection period, I would say 2 to 5 years. The issue that I have with Netflix, for example, is that I don't know if they have a really clear mode. Other than people are not really, I don't think they're pretty loyal to a service. Other people also have multiple services, right? That happens. So no, it's a weird industry. It's also relatively new. So I would probably give it like 5 years,
Yeah.
especially now that they're going into live broadcasting. It's just a weird direction, not a weird direction that they're taking, but you don't know how this bet will pay off. For example, for the discount rate, we normally plug in 10%. And now the interesting part for the estimated growth rate. So, for example, if we check the assumption of based on 5 years, can we check how much revenue has been growing? So that's 7%. And then, of course, we always go to the lovely people of Yahoo Finance
Yeah.
first, and they are expecting this year to grow by 29%,
Okay. Yeah. Sure.
and
Yep. Makes sense.
and next year with 20%. Uh,
I'm just always curious, where do they get that from? Like, who are these analysts? Because it's okay. We can also plug it in at some point, just for fun and giggles, for later, just to see how it's gonna look like. But if you look objectively and you being realistic, we have the following cards on our hand, right? Competition is there and it's quite fierce. Check. The revenue is not as growing as it was, let's say, 5 years ago. Check. um, it's getting more troublesome to acquire more content because, of course, everyone is competing for it, and then you have to pay a premium if you want to have it on your platform, and you still have to find some way to show that you are better than the competition, right? So have some differentiating factor apart from content. So that's why they're doing the games and live sports and stuff like that. So you have to also keep up with your expense part of things. So would it still be like, oh my god, another, let's say, few million of people are gonna sign up for Netflix and ditch other platforms out of the blue? I don't know what you just have to do for that, like even just from the consumer perspective. So do you agree
yeah,
with that?
I agree, and also that's why I have the other metrics. I was checking what their market share was,
Mm-hmm.
and I'm not sure if these numbers are reliable, but I can see that 21% of the market goes to Netflix, and then it's followed by 13% Disney and 11% HBO, I believe. And I was also looking into something else, and that's basically how much more people can they still, how much can they still expand, and it's also something that maybe as a what viewer you can do some due diligence, because I'm not sure, for example, how well presented they are in, for example, India or uh, other countries except the US and Europe. So maybe there's still some growth potential that we don't know about, that we haven't figured out. But as it seems, the revenue is not really growing as much, and I don't think these live TV channels will really boost way more. subscribers, maybe a couple that really want to watch certain sport. So yeah, I'm not sure if I can buy. Like you said, I don't believe the growth estimates that the analysts say that they will grow at. And also the 9% that we have here is also quite high if we compare. If we just keep in mind the decline in revenue that we've been seeing, because also consider that whenever whatever you plug in, right, the growth rate will maintain for the 5 years that you are plugging it in. So I think it will be more on the safer side of things if we put the 5% estimated growth rate in there.
Yeah, just was thinking exactly the same, to be honest. 5 is rather realistic, especially considering that they're gonna be, ramping up the subscription costs every year. That will be at least 5% for sure, probably even more. So
Yeah. And then the projected PE ratio. Well, I mean, it's really on the high side of things. Can we go to the maximum? So I mean, the maximum is 100, average 103 PE. Of course, they had negative years at the starting stages, so they didn't have uh, profits, so it makes sense. But if you do the 5 years, it's also insanely high.
yeah, it's
Uh,
all in the range of, at least now it's more or less stable, and of course it's very expensive multiples wise. But
yeah,
yeah,
yeah. So that is already kind of an estimation of where our valuation is probably going to go to. I think if we put a PE of 30 for the next 5 years, that's the average of the big tech industry.
yeah, and also I mean it should also make sense because if you are getting the 5% growth rate over the past 5 years, I don't think you would be willing to pay such a high multiple for that. So then it should be also going. P should be also going down. Makes
Yeah.
sense.
So and also just to compare, the PE of Disney is 24.
Yeah,
Of course, it's a behemoth. It has been there forever, but just to compare the two,
yeah, and you're paying the double, pretty much.
exactly. Um, Also for double the market share, but still. Okay, for the required rate of return, we always plot be something between 10 and 12%, because with if you just buy a index fund, you're looking at 7% to 10% annual returns. So you're stock picking, so you have a bit more risk. And margin of safety, I think we can put it pretty low, maybe 20%, just accounting for the fact that maybe you and I will have to do some more due diligence on how much can they expand in different industries, how big are these risks, and maybe then we can tone it down. But now I would say 20%. And if you click the analyze button, we'll see what the evaluation will be.
And we will see the magic number of $500 per share. But
Yep.
I also gotta admit, it's let's say discounted cash flow formula is in trouble because again, the bottom line is in trouble. And I'm just only curious. So you say the estimated growth rate, the analyst said was 20%.
Yep.
So just out of curiosity, and let's say we can bump up the P
40.
ratio to 40. It's fine, even probably more. But yeah, even then, because they still really have troubles with the cash flow, you get $130 on that, and the only thing that would drag it up is NPV formula, right? And the target valuation formula. So,
Yeah.
and then again, this one is purely because the biggest driver is the P here and the growth rate. So
Yeah.
it's expensive. It's just expensive.
Exactly. It is.
Unreasonably.
You could make the argument for the fact that, of course, it's more or less still a growth stock-ish. Also, if you look to the PE ratio, so you could maybe discount the fact that you would use the Warren Buffett rule of thumb formula, Benjamin Graham's formula might be a bit outdated, and just decide to waiver the discounted cash flow formula. You could do it, and then see, of course, that it will be somewhere around fair value if you would take the average of the target valuation formula and intrinsic MPV formula. But that's a risk, of course, that you can take if you really understand what this business is all about. And yeah,
Yeah, I fully agree here, fully 100%. And the problem is again, if you know something more about Netflix, if you know something about the industry, and you believe that it's going to be doing way better than our assumptions are, that's perfectly fine. We would be definitely on your side. It's all up to you then. It's your financial decision. But at least for us, it's just too expensive, and it's also this kind of time of the year when the market is, the U.S. stocks are recovering again, and it's just really on the rise. So there's probably going to be more buying opportunities later where you can pick it up for a better deal. So maybe you can you can put it in your watch list like that, and then you can just pop it in, and then you can just keep an eye on it later on. So that would also work quite nicely.
Exactly. And also, what Kirill and I have been seeing for a long period of time now is the fact that a lot of the stocks that we evaluate that are well known in the market are really on the overvalued side. I don't think we've ever had a fair value video in quite some while. I think American Express was one of the latest videos we did on fair value. Visa was close, but I mean, just saying that the market is really crazy right now. So it's just for you to understand what do the metrics mean, what do the formulas mean. Uh, get a get the rhythm, get into the program basically, and understand. Okay, I follow these metrics. If it goes up, I just buy. Or for example, if it goes down, I buy. If it goes up, I sell on a certain point. And that's really what you can do with 930. Just basically customize your own valuations, follow what you like to follow, based on the industry, based on the company. And with that said, Kirill, it's of course important to note where we can get it.
Oh, you asked the right question. You guys, ladies and gents, you can go to 930.com. The link will be, of course, in the description. And you can just try it yourself. You can get it for free. Quick and easy sign up. You can even just get the demo easy. And of course, we have multiple tiers. We have a monthly subscription. It's only €3 per month for $3. So have a look. It has a bunch of perks. Check it out. See for yourself, and of course, get the value from 930.
Exactly. With that said, Kirill, thank you for your insights. Thank you for watching, and we'll see you guys in the next video.